I've been telling all of our startups that you need to plan to have money through the first quarter of 2025. You must.
Whoa. Yeah. Okay.
You absolutely must. And
That's
the
8
way that
quarters of cash. Okay.
the way that I frame that out to them is 9. Yeah, 8 or 9 quarters of cash. Ideally 9. And the reason is that we have all of this positive news in the offing, but the problem is, again, there is still a lot of risk to the downside. We haven't seen David's second, dip in the recession, right? So that double dip is going to be expensive. And again, the sharps think that inflation will come back at some point in the next 6 months. That will keep the Fed's foot on the gas. Maybe it's 2 or 3 more 50 basis point hikes. The point is, Jason, you could be at 5.5. Again, we said this last week. We're going to get to a point that's probably higher than what people expect. That's probably around 5.5. And we'll stay there longer than people want. That's probably through the middle part of 24. And if you don't prepare for that worst case scenario, you're doing yourself a disservice. I think the market can start to rebound in the second half of 24. But if you're a company, you need to balance and plan for the first quarter of 25. Because, again, most venture investors are going to want to see 6 months of data on the ground that things are better before their sentiment changes.
Yeah.
And we're just starting to see the drawdowns. We're just starting to see the impacts in people's portfolios. That will drive behavior change. I mean, this SBF thing is the tip of the iceberg in terms of the money at risk. I went and, by the way, I did an analysis. I shared it in the group chat. Hopefully we can show this up. Brad has a little chart. Nick, maybe you can throw up the historic drawdowns. So for people that care about early stage technology, since 2018 through 2021, and including an estimate for 2022, we have injected $1 trillion into venture capital. And if you look at historically how money has been lost in periods like this, and you layer that into 2018 to now, what it basically tells you is about $500 billion of that trillion from 18, 19, 20, 21, and 22 is going to be destroyed. We haven't even started to see that yet, right? And then if you factor in another 100 billion or so from older vintages, we're talking about a 600 or 700 billion dollar destruction of paid-in capital. So there's still, for all the good news, there's still a bunch of these unfortunate pieces of bad news that have to work its way through the system.
Yeah. And for people who are looking at the chart right now, and you can see the charts on Spotify, or if you search for All In on YouTube, we have a video version there. You just take a look at 1997. The peak TVPI was 7.5x, 7.5 times cash on cash money, and what actually got realized was 5x, right? So what paper said and what got distributed were two different things. Anecdotally, what I'm seeing in the startup world, Chamath, is people are taking the medicine, and a lot of people are shutting their companies down. They're giving up on raising money, and then asking me, which portfolio company can I get a job at? Because I, on my personal balance sheet, have been, taking a 5K draw a month, and I have 2 kids. I need a job. Can you get me a job at Amazon or another portfolio company? And a lot of acqui-hires have started to happen. And so what's happening is the consolidation of talent. People who would be a great number 3 or 4 person, but maybe they weren't suited to be the number 1 person, are now consolidating into startups. With these layoffs at Meta and other corporations, we're starting to see very talented people who had peak comp of 300, 700K a year. More consolidation of talent, stronger companies.